All right, buckle up, because the U.S. 30-year Treasury yield is pulling a Houdini, jumping to 4.96%, a level we haven't seen since the 2008 financial meltdown. Meanwhile, the Fed's gearing up to slash rates in 15 days. Think 25 basis points on September 17th, with a 90% chance, and maybe even 75 basis points this year. You'd expect yields to do a polite little dip, like a shy wallflower at a dance, but nope, they're mooning upward. It's like watching a chef burn the kitchen down while promising a gourmet meal. Let's figure out this financial circus act.
Here's the ringleader. The U.S. government's deficit spending is throwing a party with a $36 trillion tab, and in just 5 weeks, they've rolled out $200 billion in bonds like it's happy hour. Investors are like, nah fam, we need more juice, pushing yields up with a term premium on 10-year treasuries that's hit a 2014 high. It's as if the market's hosting a reverse auction saying, pay us more or we're taking our ball and going home. This debt fiesta is forcing yields skyward even as the Fed tries to play bartender with rate cuts. Now toss in inflation like a surprise guest who won't leave. U.S. core inflation's back above 3%, with core PCE at 3.9% year over year. That means the dollar's losing 25% of its buying power in a decade, on top of the 25% it's already guzzled since 2020. We might be stumbling into stagflation, prices rising while the labor market sags, with 16 to 24-year-old unemployment at 10%. It's like a bad hangover after a wild night. The Fed might pour another drink with rate cuts, but if inflation keeps partying, we're all waking up to a bigger headache.
This isn't just a U.S. rave. Check the UK, where 5 rate cuts in 12 months still sent their 30-year yield to 5.7%, a peak since 1998. Japan's 30-year yield hit 3.2%, a 30-fold leap from 2019. It's like a global relay race where everyone's dropping the baton. Gold's sprinting up, syncing with Japanese yields like a dance partner, signaling a rush to safe havens. Sounds like the world's debt party is about to crash. Pass the popcorn. So, what's this mean for crypto daredevils? Rising yields and a wobbly dollar are like a green light for Bitcoin and Ethereum to rev up. As fiat turns into monopoly money, decentralized coins look tempting. Gold's rally hints crypto might follow, especially if stagflation hits and central banks fumble like clumsy jugglers. But hold your horses. Higher yields could give the dollar a temporary steroid boost, knocking risk assets like crypto for a loop. Keep an eye on Bitcoin's $60,000 to $70,000 zone or Ethereum for a wild swing, but expect a bumpy ride. For traders, shorting TLT, that Treasury bond ETF, was like catching a perfect wave, predicted to drop to $85, and it's happening. If you're in crypto, this could be your surfboard moment, but it's a gnarly sea. Higher yields might tame the risk party short term, so watch those technicals and macro waves. The board's yours to ride, just don't wipe out. This is no small sideshow. It's a global blockbuster. Governments are drowning in debt like ships with leaky hulls, and central banks are losing the helm on interest rates. The Fed's September 17th move could rewrite the script, cut rates and risk more inflation, or pause and let the economy sink. The market's next act might shape the next decade. With Japan and the UK as cautionary cameos, this debt drama's just getting started. Grab your front row seat.